Enterprise resource planning systems process thousands of transactions a day, but a single misclassified tax entry can fracture the general ledger, corrupt the audit trail, and trigger severe regulatory penalties. Inside JD Edwards EnterpriseOne, tax processing relies on specific logical routing to allocate every dollar to the correct liability or asset account. Tax explanation codes in Table 00/EX control routing by executing calculations and dictating AAIs, rules for general ledger debits and credits. We'll apply a control scenario, a $1,000 purchase, 10% tax, three-way match, across codes S, U, and V for sales, use, and value-added tax. The physical reality of the purchase, receiving $1,000 worth of goods in the warehouse, remains identical in all three cases, but the financial footprint generated in the ERP system diverges based on the code chosen. The choice of a tax explanation code determines the company's liability profile and asset valuation on the back end. We begin with code S, representing seller-assessed sales tax. Under this rule, the supplier pays the tax authority and passes that cost on to the purchasing organization. The three-way match begins at the purchase order receipt phase, using program P4312 to record the physical arrival of the goods. For the goods, the system logs a $1,000 debit to inventory asset, offset by a credit to the received not vouchered account. With code S active, distribution AAIs trigger, debiting purchase tax accrual for $100 and crediting R&V tax. The transaction moves to the general ledger post phase, using batch program R09801. The system clears the R&V balances and generates a single credit of $1,100 to the AP trade account. The tax is combined with the cost of the goods. Under Code S, the tax burden is absorbed as the cost of the asset. The company's only recognized liability is the total gross amount owed directly to the supplier. Code U dictates a different path for self-assessed use tax. The purchasing organization bypasses the supplier entirely, remitting the tax directly to the tax authority. During the initial purchase order receipt phase, Code U behaves identically to Code S. The baseline goods hit the inventory asset and R&V accounts in the exact same manner. The critical divergence occurs during the voucher match phase. Code U explicitly blocks the $100 tax from being included in the gross voucher amount. The supplier is only billed for the $1,000 cost of the goods. This instruction dictates where to route the cordoned-off tax. FinPT splits the liability. AP Trade receives a credit of only $1,000. Simultaneously, the system generates a separate credit of $100 to a dedicated use tax payable account. This creates a specific operational requirement for the accounting team. They must later generate a separate voucher to offset the use tax payable account and remit funds directly to the government. By isolating the tax liability, it prevents overpaying a supplier while enforcing self-assessed tax compliance. Code V manages value-added tax, or VAT. The core principle of VAT is that taxes paid to suppliers at purchase are recoverable from the tax authority at a later date. The primary accounting risk with VAT is improper valuation. If recoverable tax is absorbed into the cost of goods, inventory asset values become artificially inflated. To protect valuation, JD Edwards prohibits tax accrual during the PO receipt phase. Tax fields remain empty, with only $1,000 hitting inventory and R&V. Later, during the GL post phase, the system updates the AP trade account with a $1,100 credit. To balance this credit without inflating inventory cost, the system uses Financial AAI FinPT XXXX. This routes the $100 CAX into a dedicated asset account called VAT Recoverable Tax. This debit balances the ledger against the AP trade credit, keeping inventory value at $1,000. Downstream, this $100 recoverable asset will be offset against the output VAT collected from customers when the final product is sold. Code V divorces the tax burden from the inventory cost, generating a temporary asset that balances the ledger while the company waits for government reconciliation. These three final ledger states show how tax explanation codes route transaction data. Code S embeds the tax into the asset and AP trade. Code U splits out a dedicated use tax payable liability. Code V isolates a VAT recoverable asset. While the F0011 account ledger is now mathematically balanced in all three scenarios, the company is not yet ready for a tax audit or a formal tax declaration. The account ledger tracks financial distribution, but it lacks the specific tax tracking fields required for governmental reporting. Compliance requires the F0018 table, commonly called the taxes table. This acts as the dedicated repository for tax history, isolating specific tax authorities, rates, and amounts. The F0018 table does not update automatically just because a tax code was used on a purchase order or voucher. This diagram illustrates how the data update depends on the processing options configured within the General Ledger Post Report, or R09801 batch program. This program decides whether tax data moves out of the ledger and into the taxes table. If configured incorrectly, transactions post to the general ledger, but the F0018 table remains blank, losing the audit trail. Finally, the R0018R program allocates the tax amounts into their final destination, the F0018R Tax Reconciliation Repository. Tax compliance in JD Edwards EnterpriseOne requires dual discipline: the selection of the correct explanation code to route the liability and the configuration of the back-end batch processes to secure the audit trail.